welcome to Money Talks. I'm Peter Switzer. This is a show where we have one really simple goal, and that is to make you richer. On tonight's show, with the budget done and dusted and the election looming, how should this influence the way you invest? What are the opportunities and the threats? To do this, we have E-Invest Portfolio Manager, Stephen Bruce, whose job is to make sense of the political curveballs being thrown at the stock market from Bill Shorten and Scott Morrison as they compete for the keys to the lodge. And helping us detect budget, money-making and money-saving stock plays, I have Bell Direct's Julia Lee joining us a little bit later in the show. Let's get on with it. Steve, welcome to the program.
Thanks, Peter. Good evening, everyone.
Now listen, I've got a slide which I thought summed up the issues that we should be thinking about when it comes to the stock market. I don't know if we've got it up immediately. Here. We've got the budget tax cuts. We've got probably a stronger growing economy for a number of reasons, but the tax cuts should help. The election is over effect, because at the moment we're in the pre-election effect. There's MSF retiree effect if Bill Shorten wins and changes tax credits. And the got to get into effect before January 1, which a lot of people probably aren't thinking about. But let's just go from the top now, the budget tax cuts. What do you think it's going to do to the stock market and the way that you're going to invest?
Okay, I think obviously tax cuts are always positive in terms of consumer spending, and we know consumer spending has been soft in recent times, albeit the February numbers did actually show a bit of a bounce. It's directed at low and middle income earners to start with. That'll be hitting bank accounts in September, October, so we can expect a bit of a bounce there. What does that mean from an investment opportunity? You think about consumer discretionary stocks, a JB Hi-Fi, for example, the sort of places where you can buy things for $500, $1,000, a one-off sort of purchase. But I think really to have a more sustained boost in spending, we need to get a bit more positive sentiment back. And I suppose just take a step back there and set the scene. There's a lot of negativity around at the moment, but we at Perennial Value and E-Invest, we tend to be fairly glass half full kind of guys in terms of the economic outlook. And looking, when we look at the Australian economy in general, we see a lot of reasons to be quite positive. I mean, when we look at it at the highest level, we've got this strong population growth driving economic growth. We've got a low level of government debt, one of the 8 or so countries that have got a AAA credit rating. And what did the budget tell us? That the budget's almost back into the black next year. I mean, that's remarkable how many developed countries can say that these days. Commodity prices continue to be strong. Big spending on infrastructure coming that'll soften the roll-off in housing construction. Mining capex is picking up. So when we think there's a lot of reasons to be positive, regardless of the election, regardless of the budget.
Well, Stephen, when you're enjoying your life, I get trolled on Twitter because I keep doubting that house prices are going to fall by 40 or 50%. Do you guys have a view on the house prices? Because if they're right, the market's going to be down, the house price market, everything's going to be shocking. What do you guys think about house prices?
Housing prices down 40 to 50%. It is not entirely impossible, but all sorts of things in this world aren't entirely impossible. So what are we down 10% now off a very high base? Is that a big deal? I don't think so. I mean, how long ago was it were all the headlines and discussion was a housing affordability crisis? House prices have done this. Everyone by and large is still well ahead. So I think if you think about the rebasing in housing from where it was and you combine it with the changes the banks have made to their lending policies, I think this is all a very healthy, very good thing for financial stability going forward. And in terms of what does that mean? Why do you actually end up with a spiralling housing downturn? It's because interest rates are rising or people are losing their jobs. Interest rates are low, appear to be staying low, and unemployment is low, and the forward indicators on employment are still pretty good. So it's hard for us to see that your base case can be a significant decline.
And I know on Sunday morning, though I was allegedly holidaying in Byron Bay, I was up early to see what happened to the job numbers in the US. And of course, if they were 20,000, you and I might be a little bit more negative than we are at the moment, but they were 190,000, rather than 175,000.
And this is the thing, I've been talking about how the Australian backdrop's pretty good, but you look around globally, sure, there's all this political noise, Trump's carrying on, Brexit, trade wars, etc. But if you take the political noise away, the US economy is still continuing to grow at a reasonably healthy pace. Unemployment is very low. wages are starting to rise. The Fed said we're not going to raise rates again in the near term, which will underpin market, and that'll get the housing market going again as that 10-year bonds come down. Activity in the housing market in the US has been picking up again. And the Chinese data, China that everyone was worried about, seems to be showing some more positive signs. So at a global level, the backdrop looks pretty healthy.
Okay, we're in a pre-election phase now, and we will eventually, after May 18 or May 25, being post-election. Do you think we'll get a bounce for the stock market because there's anxiety before an election?
Yeah, I think that's a reasonable thing to expect. There is always a pause in people's behaviour, be they individuals or corporates, in the uncertainty around an election. You wait to see the outcome, see how the chips have landed, and then make your plans going forward. And either way, following the election, you're either going to get tax cuts or you're going to get some good spending, both of which should be reasonably positive.
Okay.
And are possible because of the strength of the country's position.
What are SMSF retirees going to do if Bill Shorten wins and is going to change the ability for them to receive a tax refund? Do you think dividend paying stocks could be affected, or basically they're still going to have to rely on them anyway, aren't they?
Yeah, well, that's how we would look at it. I mean, and this is far from a fait accompli. Labor have got to win.
The Senate might say no.
Exactly. Labor have got to win the election, which seems likely, but then you've got to get it through the Senate. And the Senate's stated position of the crossbenchers so far, and subject to how they change, is that they won't vote in favour of it. So, there's some big hurdles to cross before it's implemented. And I would suspect, at a guess, maybe you get some compromise whereby the amount of franking credits you can claim back is capped 10 grand, right? So the people with a typical balance get a reasonable amount, people with enormous balances don't. And that seems pretty fair. But so how does that affect individual stocks? So when you think about it, who actually owns stocks? If you look at a typical stock, say a big bank, for example, the share register is split roughly 25% offshore institutions. Now, they didn't get franking credits to start with.
Okay.
About 25% domestic institutions, and your domestic institutions are typically accumulation vehicles, so they'll still be able to use franking credits. So that leaves half of the register, which is, I guess, the directly held Australian retail, self-managed super funds, etc. And roughly half of those, or a bit less than half, are actually in the tax-free pension phase, with the other half being in accumulation. So it's really only 1/4 of the shareholder base who will be affected. And when you look at the share prices of, say, the banks, they're not trading at particularly high levels. So you would think there's a fair bit of negativity baked into the price, and B, 3/4 of the current investor base aren't going to be affected anyway. So we wouldn't think it would have a big impact on share prices. And then when you think of it from the other angle of why do retirees own these, it's because they have good levels of income. Even if you take away franking credits as a worst case scenario, when you compare what a bank will give you compared to the alternatives, be they term deposits, fixed income, bank hybrids, they're still head and shoulders stand out as your best income generating alternative.
Without a doubt, Stephen. Now, we're going to come back from the break, and Julia Lee will join us and talk about the stocks she likes post-budget and even post-election. But I also want to run by them the idea that Bill Shorten actually could be good for stocks and property after the election, at least for 6 months, then after the break. Welcome back, and Julia Lee from Bell Directors joined us, and she's going to tell us about the stocks she likes. But before we do, I got to the last little point that I think that stocks, Julia and Stephen's still with us, of course, that Bill Shorten could actually be good for the stock market and properties at least between the end of the election and January 1. A lot of my friends are calling him Bill Short Term for that reason. But let's go with you first, Stephen. What do you think? Because the capital gains discount will go from 50% to 25%, some people might be buyers before January 1.
Well, that's right. As we said, we don't expect big falls, but if there were, you could get a bit of a floor from that effect.
Yeah. Julia?
Absolutely. I mean, if the capital gains tax changes do come into effect from the 1st of January, especially with big ticket items like property, where you can draw down and then, that property may continue to give you negative gearing impacts, there could be a short-term rise. In fact, I've been looking for my forever home, and I've been banned from buying it until after 1st of January.
Yeah, well, maybe you should have a crack at your bankers. Everyone might pick up, if they're watching this show, all of a sudden people now know Bill Shorten could be actually good for property and shares for 6 months. After January 1 could be a worry.
But the question is, who buys property for 6 months? I guess it's...
No, but the thing is this, if you buy it beforehand, you get the full discount.
Yes, that's
you get a full discount.
But she said it was for Forever House.
Yeah.
Yeah,
You
no,
don't-
I
they
don't get
don't
the
like
discount on my Forever House.
She
no,
pretends it's
no.
forever. But your old boss, Paul Rickard, has actually calculated there's an 18% gain in buying an investment property before January 1.
And apparently there's already been an uptick of interest in apartments on the Gold Coast and investment properties.
There are smart people out there. Okay, Julia. And Stephen, I'm happy for you to say to Julia, what a load of rubbish, and vice versa, because when we fight, it's good, but nice fighting. The stocks that you like post-budget and then pre or post-election, analyse it. And we'll go to you after that, Steve.
First of all, it's hard to make moves now on the budget moves because a lot of it does have to go through law first before it's initiated. But, you know, there is going to be big spending in terms of medical imaging, especially MRIs. So if you think about the diagnostic imaging companies on the Australian market, so apart from the big ones like Helios, on the smaller end, there's Integral Diagnostics, which looks heavily at MRIs, and it's been on the acquisition trail over the last couple of years. And you can see that uptick just at the end after the budget. So in the last week, we've seen an uptick, and certainly if those measures get through, it would be a key beneficiary. So you'd no longer expect that segment of the market to grow at sort of 3 to 5%. You'd expect to see an extra boost there.
Yeah. Have you got a view on that company?
Oh, absolutely. I mean, that's one of our stocks too, so we're fully in favour of that one. Funding those MRI machines, it'll be good.
Have my viewers missed a boat with this, or is this a company worth supporting over time?
I think the demographics are playing into the favour as well. So when you have a look at medical imaging, especially the high level things that Integral Diagnostics is looking at, I think the demographics is working in its favour. And when you have the extra government spending, this was a key risk, not only in the mid-year budget, but also the one that we just saw. So I think it's played in the favour.
Okay.
I think also looking at that company in particular, that's an industry where there is ongoing consolidation, and Integral's one of the smaller companies that's driving that at the.
So it could be a takeover target too.
It can be a takeover target at some point. There are some big players there.
Yeah. Look, Steve mentioned earlier that the tax cuts would have impacts on companies like JB Hi-Fi and whatever. If you also throw in the small business changes that the instant write-off being increased from 25 to 30,000, and now middle-sized businesses up to $50 million can get in on the act. It's going to be good for companies like Wesfarmers through Officeworks, JB Hi-Fi, Harvey Norman. They all benefit from small business spends, don't they?
They would, but you'd think that the offset currently would benefit them as well, and yet the share price hasn't seen a sustained uptrend in terms.
But Harvey Norman's done really well over the last 3 or 4 months.
So it depends on what time frame you're looking at, but the tax offset's been there for a lot longer than that. So I think Harvey Norman has seen an uptick over the last 3 or 4 months because it's international
Post
business.
my interview, as a matter of fact. But
absolutely, and its international business has been doing really well. So the market started to factor in that perhaps the international business is going to be an engine of growth over the next decade, and that's, I think, given a bit of revival in terms of its shares. But here domestically, I think there's still a lot of doubt on those discretionary retailers, especially bricks and mortar. And Harvey Norman traditionally has been, I guess, grounded by its property portfolio. And I guess property at the moment, residential property, is going down, and you'd have to argue that perhaps other forms of property may be closer to the peak than the bottom of the cycle.
Stephen, you mentioned JB Hi-Fi. Obviously, you like it better than HVN.
Yeah, I think they're very good at what they do. But when I was talking about JB Hi-Fi, what I said before is it's a bit of a one-off. We're talking about the first lot of tax cuts. It's a bit of a one-off boost. I think what we'll need to see for the retail sector to more broadly, pick up momentum is a stabilisation in housing prices, and that should lead to people, being able to better assess their personal financial position and hopefully lead to a pickup in spending on a more sustained basis.
Yeah, okay. Now, Julie, give us another stock for either post-budget or pre-election or post-election, because if there's going to be a post-election effect on stock, we want to buy it now at low prices. So Come on, excite us.
Well, pre-election, let's start with now. I've been coerced into watching Married at First Sight by my husband, who's addicted to all sorts
What's
of
wrong with
types of shows.
Watching stupid shows like that. Should be watching this show on double repeats, but go on.
Honey, if you're watching. But the point of that story is, $136 million spent on advertising already by the federal government. So pre-election, some of these media stocks do benefit from that increased spend in terms of advertising.
So which one do you like, 9 or 7?
I like 9.
9?
NBC.
Do you like 9 because of it's also diversified into Fairfax as well?
Well, look, I think the Fairfax side is a little bit harder, but I like 9 because of the ratings. And when you're looking at the advertising market, advertising tends to trail ratings. So the bigger your ratings, the better your hit is going to be with the advertising market. And I think you're going to continue to see an effect come through for 9 Entertainment. As you can see, it looks like it's bottomed out and it's started to trend upwards. And those ratings are hugely important.
Yeah, well, you, Stephen, you're an old-fashioned kind of guy who likes old
in terms of media.
Yeah.
Well, funnily you should say. I mean, one of the stocks that we're finding interesting at the moment is Zoom Media, the out-of-home advertising, billboards and street furniture, etc. And now they don't benefit directly from political advertising in general, but if when we get through this sort of post-election period, if there is a bit of a pickup in spending and advertisers start to increase their spending, it's one that will benefit from that. It's integrating a merger and sort of a number of sort of company-specific things to make the stock interesting as well.
Okay, so I've been giving Julia the dominance in this segment. Another one that you think is either election or budget related.
Well, and one of the characteristics of both parties' policies and following on from state government policy as well is a pickup in infrastructure spending. Yeah. And so how do you play that? I mean, there are companies like Boral, for example, supplier of raw materials, which is currently trading at a very depressed share price for a range of issues, but that's a positive driver there. CIMIC, for example, big, very large construction company, can play that. And even Macquarie, they tend to get themselves into these things one way or another as well.
Let's go back to Boral, because Boral's had US issues as well. How come, considering that the US is growing pretty well and infrastructure spending is pretty significant and the housing sector has gone for the boil a little bit?
Yeah, well, the housing sector has slowed down a little bit, but as I was saying before, with the bond rate coming down, we'd expect activity in home building to start picking up again. And it hasn't come back too far. We're sort of sitting at mid-cycle levels. But really, they're integrating a large acquisition, and as always, there have been issues around that, a bunch of problems with plants not performing properly. And then the sort of common excuse of weather. There's been some quite extreme weather in the US. So as we cycle through those things, there's reason to think, reasons for thinking that the US earnings trajectory will start to pick up as well.
Okay, Julia, what do you think on infrastructure?
I like Lendlease. We have seen a pullback in terms of
And they've had a
shares.
shocker for a while, haven't they?
Yes.
It's due for a turnaround.
Well, if they spun off their engineering business, that would be a key catalyst. But in terms of the infrastructure side, Lendlease benefits there as well. And I guess Boral, in terms of the fly ash business, one of the things is that fly ash comes out of coal plants. And unfortunately, coal plants are decreasing, especially sort of in the US and parts of the globe. So I guess when they looked at that, one of the questions I'm asking myself is whether that's a big structural shift that we are seeing. Okay,
we'll go to an ad break. When we come back, we will have a look at the post-election effect and also the Bill Shorten effect after the break. Welcome back, and we're trying to find stocks worth investing ahead of the election, post-budget, and also because Bill Shorten is likely to win the election, that's the expectation, and he wants to change, or has promised to change the capital gains tax as of January 1. Could there be an investment ahead of that particular change? Julia, what do you like? Post-election, post-budget, or whatever?
I'll have to say Coles. The two major parties disagree on a lot of things, but one of the things that they do agree on is tax cuts to lower income families.
Yes.
And generally that's good for the economy because lower income families tend to spend that money. And I think firstly on staples, so companies like Coles and Woolworths, and I'd prefer Coles at the moment, and then on discretionary. So I'm a big backer of what Coles is doing, especially in terms of that partnership it has on its online business, which I think is a major investment and should give it a competitive advantage over the next 5 to 10
years. When I taught
years.
economics at the University of New South Wales, we said that the marginal propensity to consume of a poorer person was closer to 1. I mean, they spend it all. And that's part
And
of the
it's
reason.
great for the economy. I think if you want to get the economy moving,
Yep,
you know.
most definitely. What do you think of Coles, Stephen?
We think Coles will benefit as all retailers will from an extra cash drop. It's cheaper than Woolworths, although it's got lesser sales momentum. So we're generally a little bit no buyback, which is always very helpful. Yeah. But we tend to be a little bit more on the cautious side, just around the supermarkets at the moment.
Okay. So what do you like?
If I sort of picking a stock, this is more of a long-term view. Downer is one that we're interested in. The core of Downer's business now is really providing outsourced management and maintenance services to a whole range of different types of infrastructure and facilities and services. And as government, they're committed to spending more on hospitals and schools and stuff, and that all has to be managed. And a lot of that is outsourced. And companies like Downer, which now own Spotless, really step into that area there.
Yeah, because Downer's made a lot of mistakes in its life, hasn't it? And in recent times, it looks like they've found the right area to be in.
Yeah, that's right.
Yeah. Julia, let's just work on the idea that Labor's policy could actually help the house price problem, because it could mean that some investors will say, right, well, the capital gains discount's going to be reduced. I can't get retiree tax refunds as a retiree. I might just go out and buy an investment property which I'll hold for the next 10 or 20 years and get a regular rental in, and when I do eventually sell, I'll still get the 50% discount, or my dear children, when I pass away, get the benefit of that, which most children I don't think deserve. So, is there a company out there that you think might be a beneficiary?
Sure. When I think about it logically on the margin, when you're looking at negative gearing, the biggest benefits are from new apartments, because the depreciation cost is the largest on new apartments or new housing. So probably something like a Mirvac would be probably my pick in the short term. I probably wouldn't hold in the medium to long term because of the risks that after the 1st of January, if we do see capital gains tax and negative gearing impacts come into force, that could have a negative impact in terms of the share market. So it would be more of a short-term play, probably over the next 4 to 5 months.
And you've got to remember that when you come to sell, the next buyer has to be basically, could be an investor, but he's not, or she's not going to get the benefits that they currently exist, and that could be a real change for the market, couldn't it?
That's right. So it'll have to be priced the same way.
Yeah, guys. Thanks very much, Stephen Bruce from E-Invest and Julia Lee from Bill Direct. Thanks for joining us on the program. Now, coming up, the Switzer Investment Strategy Day is coming along. It's going to be in April, end of April and early May. If you want to attend, a lot of the champion fund managers who've been on the show will be attending and talking about their various funds and whatever, and how they're going to invest in this politically challenging environment. So if you want to attend the event, it's www.switzerevents.com.au. I'm Peter Switzer. Thanks for joining us.